Can you update us on what you're seeing right now? It's been a big week for silver and what you're expecting moving forward with silver.
Yep, it's the breakout we were waiting for. Let's look at the fundamental reason, though, driving this 14-year technical upside silver breakout. And while lagging gold, foreign exchange silver came into the SGE crosshairs directly after the Bank of International Settlements forced FX spot gold to become deliverable. Now, following gold having been revalued as a first-year high-quality liquid asset on the 1st of January 2023, China, Russia, and BRICS nations began stocking up physical silver for military, AI, and green energy applications. Military being a big component. However, now that the US has recategorized silver as a critical mineral, what it's done is ignited a race by the US to also stockpile silver, severely limiting the sales of US silver, in turn incentivizing global sellers to hold out for yet undetermined but significantly higher physically determined prices. Shane, here's the monthly target you referred to that we circled in our last episode, which was right here, and the price was way back here. And the end of the month, this is a monthly bar, the end of the month exactly fulfilled the August target. Now, while we expect $52, 53 in fact, or very close to 53, to be secured as the next higher stair step to rally from, along the way, the next immediate target is 44,275. Now, this is a futures chart where we expect a fight here, but very large commercial short stops sit above this pivot. This is where a huge amount of shorts were added, and not all of them have been covered on anywhere close to getting covered on this rally. So you're going to see some resistance and you're going to see a fight, but once it's through, then really it's blue sky. And guess what? Beijing knows exactly where these stops are, here and here. Following Trump's unhelpful confrontational comments today, this is the Wednesday the 3rd, Russia, India and China are targeting both gold and paper silver for conversion into physical. This fresh retail demand has not yet translated to the retail market, but it will, further tightening up the fifth consecutive 200 million ounce per annum supply shortfall, providing yet another catalyst to easily drive spot silver through all-time highs. With the US now competing to secure tight for supply physical silver, it's going to unsettle the SGE's stealthy 5-year privileged physical concentration position. Now, the gloves have come off, and over the last 5 years, the SGE has successfully utilized control of its global position concentration, employing SGE physical to unallocated spot hedging mechanisms, which were structured to enable them to arbitrage the difference while at the same time containing the silver price, as it strategically was flowed into Beijing vaults. Guess where it was coming from? Well, out of the West. So geopolitics, trade wars, and a direct frontal attack on competing BRICS nations declared Beijing no longer needs to be stealthy buyers. And with the CME LBMA open interest migrating out of Beijing's unallocated playpen, so they don't need to play this game, they have enough silver. The race to accumulate silver, along with all critical mineral assets, is underway, catching the US severely on the back foot. The US has come out of the gate with almost no silver reserves, which will mean they will heavily sanction or ban US silver exports. Almost certain. However, the Fed has accrued a very large naked short unallocated Office of the Comptroller listed FX silver position. It's the only place it shows up, which will now come into Russia and Beijing's crosshairs because they know about it too. So they know that has to be short covered because there is no silver to back those positions up. And technically, FX silver should be deliverable. Now, the White House mandate to buy silver will drive an inflection point, forcing the Fed to buy back these unallocated bets into higher and higher prices. So drilling down, note the massive end of session margin call where we had a $1.07 EFP basis spread required to short cover the asymmetric imbalance COMEX-centric December futures so-called hedges versus the spot long legs being locked in and called for delivery. Now, footprints indicate this was commercial short covering, which drove spot silver into these 14-year September 2011 highs. Worse, into yesterday's silver short squeeze, into the margin calls, captured here, the EFP basis trade short squeeze had expanded to as high as $1.24 at the open. And given all the major bullion banks are long silver for their own book, there was little doubt these short capitulations were Fed-related OCC bets being bought back. This jives with evidence that the 5-year Fed-held OCC derivative bets against both spot gold and silver had been short covered during the first quarter of 2025. So as expected, December silver futures deliveries have commenced in very large size following first notice. There was 7,702 lots, which was 1,198 tons. They were delivered with another 584 lots yesterday. And there's still about 400 tons left to deliver. So really, in summary, into dwindling overall COMEX open interest, the CME LBMA market makers in both gold and silver are increasingly becoming price takers. To those looking at analyzing the house-generated COT reports, which I know a lot of traders do, the fact that these reports fail to indicate the degree of COMEX to FX spot imbalances, i.e. that which lots are hedged or not hedged, what gold is doing is flagging a risk about US debt that other assets simply are not. And with that in mind, there's never been a better time to opt out of the debt-riddled fiat system by simply swapping your debasing dollars, euros, pounds, yen, whatever, for physical gold and silver.
It's been one of those weeks where you feel the ground shifting under your feet, where silver doesn't just nudge higher, it kicks the door down and says, right, I'm here and I'm not leaving quietly. We've been talking about this breakout for a long time, but now it's finally here. And let me stress this. It isn't just another technical breakout on some chart that traders will forget in 2 weeks. No, this is the culmination of years of suppressed price action, structural shifts in how the global market handles silver, and geopolitical power plays that are literally rewriting the rules of money. So let's put the pieces together. Everyone likes to talk about gold, and rightly so. Gold's the big brother, the one central banks hoard when the system looks wobbly. But silver's the street fighter. It's more volatile, more aggressive, and when it breaks out, it punishes those who doubted it. That's exactly what we're seeing right now. The first thing I want you to notice is this 14-year technical breakout. That's not a short-term blip. The last time silver had this kind of setup, we were in 2011, and it went screaming to $50. And remember, that was during a time when QE was flooding the system, but inflation was still relatively contained compared to what we've been living through now. Today, we're not just talking about inflation. We're talking about a complete breakdown in trust in fiat currencies, ballooning sovereign debt, and central banks openly competing with each other for who can print the fastest. That's the backdrop, and silver is responding accordingly. Now, why is this breakout happening? Let's cut through the noise. The Bank for International Settlements quietly forced FX spot gold to become deliverable. That was huge. It was a change that most mainstream analysts missed, but it changed the dynamics in the gold market. And once gold was reclassified as a Tier 1 high-quality liquid asset in January of 2023, it was inevitable that silver would come into the crosshairs too. China, Russia, the BRICS. They've been stocking up on silver just as aggressively as they've been buying gold. And here's the kicker. It's not just for jewelry or coins. No, silver is now a critical component of military hardware, AI technology, and green energy infrastructure. In other words, silver is no longer just a monetary metal, it's a strategic weapon. Think drones, think solar, think 5G systems. You can't do any of it without silver. So when people ask, why is silver breaking out? The answer is simple. Because the world has woken up to the fact that it's not optional anymore. And then, just when you thought it couldn't get more interesting, the US recategorizes silver as a critical mineral. That was the moment the gloves came off. The US has almost no reserves to speak of, yet suddenly they're in a race to stockpile silver. What does that do? It pulls supply off the market, and it forces sellers to hold out for much higher prices. Why would a producer sell at $30 when they know the Pentagon is willing to pay multiples of that to secure supply for missiles and solar panels? They wouldn't. So the sellers are tightening their fists, and the buyers are scrambling. That's how you get a breakout. Let me show you what's happening technically. Back in August, we circled a target, and silver hit it right on cue. Now we're looking at the next immediate target around $44.27. There's going to be a fight there, no doubt about it. That's where a huge chunk of shorts were added, and not all of them have been covered. But here's the thing. Once we push through that resistance, once those stops get blown out, the sky's the limit. I'm not exaggerating. This is exactly the kind of setup where you get a cascading short squeeze, the type of move that leaves traders gasping for air. And trust me, Beijing knows exactly where those stops are. They've been playing this game long enough. Speaking of Beijing, let's not ignore the geopolitics here. For the last 5 years, China has been quietly siphoning silver out of the West. They use the Shanghai Gold Exchange as a stealth accumulation mechanism, arbitraging the difference between unallocated Western contracts and physical delivery. They were content to play the long game, building vaults, taking delivery, and biding their time. But now with trade wars escalating and tensions boiling over, they don't need to be stealthy anymore. The race is out in the open. The United States and China are now directly competing for silver.
We're looking back, I can't believe it, actually ending the third quarter. It's been a lot of fun, though, pulling apart over the time. You remember we've had multiple official attempts to try and talk gold down, tamp it down. And most recently, I mean, this is so recently, Citi, even less than 2 months ago, I think it was 7 weeks ago, whatever it was, tried to gaslight the idea to sell gold because it was going to go down hundreds of dollars to as low as 2,600. Do you remember we kind of laughed at the whole concept of it because we knew they were on the other side. And yeah, this is the same bank that along with JP Morgan that we captured and published at that exact same time, simultaneously stealthily closing the Fed's 5-year OCC derivative bets. Remember those OCC bets, the officer controller bets? They're only published quarterly. So these guys get to have a bit of fun and do what they want to do in the dark until it's published. But we clocked it. And this really actually all boils down to the fact that the only central bank still short gold is readying to revalue US Treasury gold reserves. I know there's a lot of skepticism about it. It's happening. And as we've been drawing attention to, and we will look at it again shortly, the clues are all there. And our assessment that the LBMA COMEX is no longer fit for purpose is now gathering mainstream attention. And with that in mind, let's look at the current August CME LBMA footprints, which after the Trump tariff tantrum further reveal how a dwindling COMEX open interest, i.e. the chips, no one wants to really trade the chips anymore. It's forcing discipline on the Fed, the only remaining central bank trying to cap the price of gold and versus the dollar. And they need the COMEX to do that. And it is just, there's not enough actors. And even setting aside the Western paper-derived price mismatches versus the Asian-facing physical pricing, it was the Trump tariff tantrum that really exposed the massive structural mismatch between the Western gold market infrastructure and particularly the inefficiency of re-refining London 400-ounce bars into 1 kilo bars that Asia demands. Liquidity providers affirm that the remaining COMEX open interest, that's the chips in the casino basically, are insufficient to command enough position concentration to actually meaningfully enable the COMEX-centric paper gold price management to continue. Now, the Fed's price suppression attempts have become so obvious their anticipated intraday, intra-month, COMEX-centric official bid-pulling attempts are capitalized on by the competing global central bank, sovereign, and institutional buyers. Now, these arbitrable physical offtakes are making it increasingly difficult for the Fed to short cover leased bullion borrowings without digging a deeper hole. Into the end of the month, the Bank of International Settlements squaring, the OCC bets, were once again forced to be squared at an all-time higher priced stairstep. And with physical market liquidity now setting the global gold price, the Fed will have to fold its short derivative hand and as quickly as possible get on board the upcoming gold revaluation process.
Now let's get into the meat of this. We ended part 1 talking about that blue sky setup once silver clears the mid-40s. And the thing about silver is, once it gets going, it doesn't politely climb a staircase like gold. No, silver takes the elevator. Sometimes it's an express elevator straight to the penthouse. Sometimes it gets stuck between floors and everyone panics. But when it's moving up, it's violent, it's fast, and it's merciless to anyone who's short. And let's be clear, this move isn't driven by speculators yet. That's the wild part. Hedge funds, CTAs, your typical momentum chasers, they're not in the game. Open interest tells you that. What's happening now is a structural squeeze. Delivery demands colliding with paper promises. You've got London claiming they can trade 600 million ounces a day, but the vaults are holding 140 million in free float. That's like running a casino where every chip on the table represents a claim on the same stack of dollar bills locked in the manager's drawer. Sooner or later, someone's going to want to cash out, and that's when the shouting starts. And here's the really dangerous part for the paper shorts. Silver isn't just a monetary metal, it's an industrial necessity. It's the lifeblood of solar panels, EV batteries, military tech, medical devices, and yes, the new AI infrastructure. You cannot run a green energy transition without it. You cannot build an advanced drone without it. So when prices rise, industrial buyers don't sit back and say, oh, well, maybe next year. They panic buy. They rush into secure supply because their entire business model depends on it. That's why silver is what economists call a Giffen good. The higher the price goes, the more people need it. Try running Tesla's gigafactories without silver. Try running China's solar exports without silver. That's why this isn't a normal commodity cycle. Now let's talk about the United States, because this is where it gets downright surreal. America has reclassified silver as a critical mineral. That's not just a bureaucratic footnote. That's the government quietly admitting, we don't have enough of this stuff and we're going to need it. And when Washington labels something critical, it means two things. One, they're going to start stockpiling, and two, they're going to restrict exports. So now the US, which has almost no silver reserves, is competing in the same global market as China, which has been hoarding for years. And don't miss the timing here. Just as the US is waking up, BRICS nations are openly pivoting to gold and silver-backed settlement systems. The Shanghai Gold Exchange has been building the plumbing for this for years. They've got vaults springing up all along the Belt and Road. The latest one in Saudi Arabia, symbolic for obvious reasons. You think Riyadh is going to keep accepting dollars for oil forever? Not when they can pivot to a system where gold and silver underpin credit. And if that repo facility rumor in Shanghai comes true, where gold and silver can be pledged as collateral for renminbi loans, then the Western system is in big trouble. Because suddenly treasuries aren't the only game in town. And that brings us to the Federal Reserve. The Fed has quietly been sitting on massive naked short silver bets. They show up in obscure Office of the Comptroller reports, but they're there. Now the problem with naked shorts is simple. You can write all the paper you want, but if someone calls your bluff, you have to deliver. And there isn't enough silver to cover. Russia and China know this. That's why they're forcing delivery. That's why we've seen billions of dollars worth of silver yanked out of COMEX in just a few weeks. It's the oldest trick in the book. Pressure the weak point until it cracks. And make no mistake, COMEX and LBMA are the weak points. For decades, they've been the price setters. But that was only possible because everyone played along. Everyone was content to settle in paper. Now, not anymore. Now the new exchanges popping up in Shanghai, In Moscow, in Singapore, in Saudi Arabia, they're saying, we'll settle in metal. No paper games. And once the market realizes that real price discovery happens in the East, not in New York or London, then the entire suppression game is over. Prices won't just drift higher, they'll gap higher, because real physical buyers don't haggle over pennies. Here's something that stuck with me. Kitco recently ran an interview quoting a senior strategist saying that London's free-floating stockpiles could be gone in 7 months if investment demand picks up. 7 months. That's not some fringe newsletter screaming about shortages. That's mainstream acknowledgement that the West is running out of silver. And if you do the math, with 600 million ounces trading a day on paper and only 140 million ounces backing it, it's not hard to see how fast this could spiral. Now let me add a touch of humor, because sometimes the absurdity of this system deserves it. Think of LBMA like a guy running a wedding buffet. He's got one roast chicken in the kitchen, but he's sold tickets promising a chicken dinner to 200 guests. As long as everyone just nibbles at the salad and sips the champagne, he's fine. But the minute 20 people head to the buffet line and say, "Where's my chicken?" the scam's over. That's where silver is right now. Too many people want delivery, and there's not enough roast chicken in the kitchen. And while all this is happening, what's the mainstream financial media doing? Yawning, talking about tech stocks, hyping crypto ETFs, pretending that a 200 million ounce annual silver deficit is no big deal. It reminds me of a tweet I saw last week. Financial media, stocks are the only game in town. Reality, gold at all-time highs, silver breaking out, central banks hoarding metal. But sure, buy more Tesla. That tweet got tens of thousands of shares because people know deep down they're being distracted. Now let's fast forward. What happens when silver clears $50? That's not just a number, that's a generational breakout point. It's a double top from 1980 and 2011. Once silver gets through that, resistance is gone. The market psychology changes. Shorts panic, longs pile in, and silver doesn't just inch its way higher, it rockets. I wouldn't be surprised to see $100 in months once $50 is taken out. And remember, that's still cheap when you adjust for inflation. The 1980 high of $50, adjusted for today's purchasing power, is closer to $200. So anyone who says $100 silver is unrealistic simply hasn't done the math. And what about gold? Because you can't talk silver without mentioning gold. Gold has already broken out. It's in new territory. Goldman Sachs, for all their faults, put out a note saying if the Fed loses its independence, gold goes to $5,000 like that. Well, let's be honest, does anyone seriously believe the Fed is independent anymore? With Trump openly pressuring, with political appointees shaping policy, with debt spiraling, independence is a joke. And if $5,000 gold is conservative, then $200 silver is too. Here's where it gets even more interesting. Luke Groman, one of the sharpest macro guys out there, made a great point. He said the US will allow gold to go much higher organically before revaluing it. Why? Because the higher gold goes, the easier it is to shore up the balance sheet. Pegging gold at $10,000 an ounce suddenly makes the Treasury's gold reserves worth trillions. It's accounting alchemy. And silver, being the little brother, will follow, whether the government wants it to or not. Now let's bring this down to the personal level, because it's easy to get lost in trillion-dollar flows and geopolitical chess games. What does this mean for you, the ordinary investor watching this? It means you've got a window, and it's closing fast. Right now, the mainstream hasn't caught on. Silver eagles are already hard to find. Premiums are already rising. But it's nothing compared to what's coming. Once silver clears $50, your local dealer won't have stock. Premiums will explode, and you'll be stuck wishing you bought when you could. I had a conversation with a client just the other day. He said, "Andrew, I feel like I'm buying insurance. I don't expect to get rich. I just want protection." And that's exactly right. Precious metals aren't about getting rich quick. They're about opting out of a broken system, about holding wealth outside of fiat games. But here's the kicker. This time, the upside could actually be life-changing. Because when the system finally admits it needs gold and silver to reset, prices won't be set by COMEX traders, They'll be set by governments desperate to restore confidence. And don't underestimate the role of politics in all this. Trump has already made comments about gold. He's hinted at revaluation. He's got Judy Shelton and Senator Lummis whispering in his ear. He's said the line that should send chills down Wall Street: he who has the gold makes the rules. Well, what happens when the U.S. realizes China has more? What happens when the BRICS announce a gold-linked settlement system and Washington is caught flat-footed? That's when revaluation goes from theory to policy. And when gold is revalued, silver goes parabolic. Let me leave you with a mental picture. Imagine two worlds running in parallel. In the West, CNBC is telling investors to keep buying tech stocks, that the Fed has everything under control, that inflation is transitory. Remember that gem? Meanwhile, in the East, vaults are being filled with gold and silver, new exchanges are being built, and contracts are being written for physical delivery. At some point, those worlds collide. And when they do, the illusion shatters. Price discovery shifts east, the paper games collapse, and gold and silver finally trade where they should.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.